Welcome back. As promised in my last video on sales and leaseback, I wanted to bring a question that deals with sales and leaseback with asset modification. Before you continue to listen to this video, what I advise you do is that you go to the first comment that contains the case study, and the second comment contains the solution to the case study. As in the previous illustration, we are taking our case study from ACCA SBR question for March 2020 of a Leria company. And for today, we are just going to have a look around the question, the standards that are affected, the steps to take, just to consolidate the knowledge that we've gained on the previous illustration. So, if you have read through that question, you are going to find that the following information are available in the question. The key information, following key information are found in that question. Key information number one is that Leria's accounting year end is 31st October, and the current accounting year end for the company is 20x5. They have entered into a contract to sell their stadium by next year, November, and lease it back immediately under a 10-year lease. I want you to note that their year end is 31st October. So to sell the asset in November after the next accounting year, that will be 13 months from this current reporting period. The asset will be sold for its fair value of 30 million. We also find that the present value of the lease is 26 million. And then they have a no obligation plan to improve the crowd barrier by the next accounting year ending 31st October, and they have taken off this 2 million from the 20 million, and that is why we have a carrying value of 18 million anyway. The question also says after accounting for depreciation of 5%, and the rate of depreciation is 5%, reducing balance. So these are the key information in the question. And one of the first things that um we that comes to mind is, with the questions in the case studies, what are the key accounting standards that have been touched in the requirement of the question? They have asked us to assess if the asset should be classified as held for sale in the current accounting year. That affects IFRS 15, non-current as IFRS 5, non-current asset held for sale and discontinued operation. Then they plan to spend 2 million that has been netted off the carrying value of the asset. We want to check if it is a provision, and we want to look at IS 37 provisions, contingent liabilities, and contingent assets. Then we are to also assess if the transfer between the Leria company to the company that is going to be the new owner of the asset, if it qualifies as a sale. For us to be able to do that, we need to look at IFRS 15, revenue from contract with customers, and then if it qualifies and we are going to do sales and leaseback accounting, we are going to be looking at IFRS 16 um, leases. So what is the first requirement? Should the asset be classified as held for sale in the financial statement of financial position of Leria Company for the year ended 31st October 20x5? Before we can answer yes or no, we need to start our discussion by looking at what are the recognition criteria for an asset to be classified as held for sale. Number one, the asset must be available for sale in its present condition, and the sale of the asset must be highly probable. That means that management is committed to selling, they are working to locate a buyer, and the asset is being marketed at a reasonable price. The sale must be completed within 1 year, unless there's an occurrence that is beyond the control of the entity that will delay the asset beyond 1 year. And the final criteria is that the management is unlikely to change their mind about their plan to sell the asset. And we need to tick all these boxes before we can classify an asset as held for sale in accordance with the requirement of IFRS 5. But you will recall that I said the asset was going to be sold by November next year, which is 1 month after the end of the next accounting period. So this has breached the 12 months criteria, and we've not been given any information that says that this is happening because there are circumstances beyond their control. So on that basis, we cannot classify this asset at the stadium as non-current asset held for sale as at 31st October 20x5. Then the next requirement is if this company, they are right in their treatment of the 2 million by taking it off the carrying amount of 20 million. We can look at it from two ways. We would look at it from the angle of IS 37 provisions, whether it is a liability. For us to recognize a provision which is a liability, it must be a present obligation arising from a past event, and the settlement of that obligation must result in an outflow of economic benefit. We are going to pay for it. Now, the decision to spend 2 million is not coming out of contractual or constructive obligation. That means that it is not a liability. It lays solely within the prerogative of the management of Leria company, whether they want to carry out that renovation or not. Therefore, they can even change their mind as a result. The 22 million should not be taken off the carrying value of the asset, but should be added back. Therefore, the carrying value of the asset for the current financial year should remain at 20 million. Another way we can look at it is if we do not want to look at it from the angle of a liability following IAS 37, we can look at it from the angle of the conceptual framework and IAS 1 presentation of financial statement and other IFRS standard that forbids companies from netting of assets against liabilities or income against expenses. For netting of assets against liabilities, the rules only change if the entity has a legally enforceable right to offset recognized amount, and these ones normally fall within the purview of financial assets and financial liabilities, or the entity intend to settle the contract on a net basis, like netting deferred tax asset against current liability, or they want to realize asset and liabilities simultaneously. So if a company is buying over both an asset and liability, we can now say, okay, let's take the liabilities off the value of the asset so that we can arrive at the value of the net asset. This is when netting off is permitted. So on this basis, we can still say that the 2 million should not be netted off because none of these cases is applicable as at 31st October 20 X5. Then over to IFRS 16 sales and leaseback. The first step we want to ask ourselves is, does this transfer from Leria company to the buyer lessor qualify as a sale? For us to be able to do that, we want to ask ourselves, has the rewards and benefit associated with the asset, has it been transferred to the buyer lessor? And if that happens, or for us to determine if that happens, we're going to look at the recognition criteria, 5 steps under IFRS 15, especially the performance obligation implicit in this contract. However, if you want to get more detailed understanding on how to deal with this, look at my previous lecture on Benito question, and you're going to find out what steps we need to apply according to IFRS 15. However, if the transfer of an asset from the seller lessee to a buyer lessor doesn't qualify as a sale, what the seller lessee will do is to continue to recognize the asset in their books because there was no sale, and any amount that they receive from the buyer lessor would rather be recognized as a financial liability in the book of the seller lessee rather than a lease liability. What if the transfer qualifies as a sale? If the transfer qualifies as a sale, these are the key things that we can do. Number one, we would recognize the asset from the book of the seller lessee. Then you recognize the right of use of the leased asset as a proportion of the previous carrying amount retained by the seller lessee. I'm going to show you how to do this. After recognizing the rights of use of a leased asset, you simultaneously recognize the present value of the lease liability under the liability segment of your statement of financial position as a seller lessee. Then you also recognize a profit on disposal. However, not all the total profit will be recognized. You recognize the profit as a proportion of, you recognize the profit as a proportion of the right that you have transferred to the buyer lessor. So, what will be the key calculations for us to arrive at a proper accounting treatment following IFRS 16 sales and leaseback? Number one, let's determine what is the carrying amount. Some questions will give you the carrying amount, so you do not need to determine the carrying amount. So, but as at the date of sale, the carrying amount ending for the year ending 31st October 2016 will be 20 million less 5%. That's the depreciation. But the sale is taking place in November. That means that we need to take 1 month depreciation for that period. Therefore, that will be 19 million that was left, less 5% of 19 million, taking just 1 month pro rata. That gives us a net carrying amount of 18.92 million as at November 20x6 when the asset is disposed. So the carrying amount at the date of disposal is 18.92 million. So what will be the total profit on disposal? Since the fair value received is 30 million and the carrying amount is 18.92, it means that the total profit on that disposal is 11.08 million. The next thing that we want to calculate would be the right of use and the profit percentage. Other lecturers take different steps arriving at the right of use and the profit to be recognized. But I use this percentage approach because it's simpler. So if you've established the present value of the lease, the fair value of the asset, you can use it to calculate the right of use percentage. So the PV of the lease is 26 million and the fair value of the asset is 30. So if you take a percentage of that, that gives you 86.6%. Then the proportion of profit recognized is the balancing figure from the proportion of right of use. So we take 86.6% of the of the carrying value of the asset that was transferred. That becomes the right of use of the right retained by the seller lessee, and 13.4%, which balances this up to make it 100%, will be the proportion of the rights transferred, and that is the proportion of the profit you recognize. So if this was 70, this will be 30. If this was 60, this will be 40. So the moment you take the present value of the lease and divide it by fair value and take a percentage, that becomes the right of use percentage. And any balancing figure is the percentage you apply on the total profit to arrive at the profit to be recognized. Then, since we've gotten the percentages, we can now calculate the right of use percentage and the profit recognized. So the right of use percentage would be based on the percentage of the proportion of the carrying value. Sorry, this is 18.92 and not 19.92. So if you say 86.6% of 18.92, that gives you 16.4 million. And the profit recognized, since the total profit we calculated it earlier to be 11.08, if you say 13.4% of 11.08, you have 1.4 million. So this is the profit that Leria company will recognize at this period, because this is the proportion of the right that was transferred to the buyer lessor. So that is what we do. And this is the right retained. So we take 86.6% of 18.92. So beyond this, we now come to the summary of the figures that we've determined or calculated so far. Number one, we've gotten the cash proceeds from the disposal, which is 30 million. The carrying amount of the asset at disposal is 18.92 million. The right of use of the leased asset is 16.4 million, which we calculated above, which is 86.6% of this amount. Then the PV of the lease liability, it was given as 26 million. The profit recognized is 1.4 million. You can now proceed to do the uh journal entry. So you have the debit and the crediting. The cash proceeds received will be debited. The right of use to the leased asset 16.4 million will be a debit. You de-recognize the asset that was sold. The carrying value was 18.92, so you de-recognize that. You credit the PV of the lease liability, and then the gains on the right transfer is 1.4 million. If you add this on both sides, you're going to have 46.4 and 46.4 million. So that brings us to the end of our discussion. If you have any question, do not hesitate to send me an email on info@kenosisAct.com or call me on 0740-524-7538. So that brings us to the end of the class for today. Thank you for listening. See you in the next video.